Hello and welcome back to our channel. Today we will be discussing one of the hot topics in the world of finance, cryptocurrency. Cryptocurrency has been a buzzword in the recent years and for good reason. It is a revolutionary digital currency that has the potential to change the way we transact with each other. So without further ado, let's dive right in. So what is cryptocurrency? At its core, cryptocurrency is a digital asset designed to function as a medium of exchange. Unlike traditional currencies such as the US dollar or euro, cryptocurrencies are decentralized and operate independently of central banks. This means that they are not controlled by any government or financial institution, making them highly secure and resistant to censorship and interference. Okay, so how does this revolutionary technology work? See, cryptocurrencies work through a technology called blockchain, which is decentralized digital ledger that records all transactions made on the network. Each transaction is verified and validated by a network of computers before being added to the blockchain. This ensures that every transaction is secure and tamper proof, as each block in the chain is linked to the previous one, creating an unbreakable chain of digital transactions. So, cryptocurrencies work through a technology called blockchain, which is decentralized ledger that records all transactions made on the network. Each transaction is verified. The main question is, why does this technology matter? The significance of cryptocurrency lies in its potential to disrupt traditional financial systems and bring about a more democratic and equitable economy. Cryptocurrencies offer more advantages over traditional currencies, including lower transaction fees, faster and more secure transactions, and increased privacy and anonymity. They also provide a way for people to store value without really relying on the centralized institutions that can subject to corruption or manipulation. Now let's get to the main part of the video and discuss the pros and cons of investing in cryptocurrency. So the first pro is obviously the very high potential returns. Okay, so one of the main advantages of investing in cryptocurrency is the high returns. Unlike traditional investments like stocks and bonds, the value of cryptocurrencies can skyrocket in a short amount of time. For example, in 2017, Bitcoins reached an all-time high of nearly $20,000, up from less than $1,000 at the beginning of the year. The potential for high returns in cryptocurrency is largely due to the market's volatility. Cryptocurrencies are known for their erratic price swings, and it is not uncommon for a coin to gain or lose 20% or more of its value in a single day. While this volatility can be a double-edged sword, it can also present lucrative opportunities for investors who are able to accurately predict market trends and make trades at the right time. Additionally, the growth potential of a cryptocurrency is significant. While the market is still relatively small compared to traditional investments, its rapid growth over the past few years have caught the attention of mainstream investors and financial institutions. As more people become aware of cryptocurrency and its potential applications, the demand for coins is likely to increase, driving up their value. Another factor contributing to the potential for high returns in cryptocurrency is the limited supply of some coins. For example, Bitcoin has a maximum supply of 21 million coins, and And as of 2021, over 18 million coins has already been mined. As the supply of coin dwindles, the value of each coin is likely to increase, providing an opportunity for investors to profit. It is important to note, however, that the potential for high returns in cryptocurrency is not guaranteed. The market is highly unpredictable and prices can fluctuate wildly in a short amount of time. Additionally, investing in cryptocurrency carries significant risk, and investors should only invest money that they can afford to lose. Ultimately, whether or not to invest in cryptocurrency should be based on careful evaluation of the risks and potential rewards and should align with an individual's financial goal and risk appetite. So, the second feature of cryptocurrency is decentralized system. The decentralized nature of cryptocurrency is one of the most important features. Decentralization means that the network is not controlled by any central authority or organization but instead operates on a peer to peer basis. This is in contrast to traditional financial systems which are typically controlled by banks, governments, or other centralized institutions. In a decentralized cryptocurrency network, transactions are verified and recorded by a network of computers rather than a single entity. This is achieved through a process called mining, in which individuals use their computing power to solve complex mathematical problems and add new blocks to the blockchain. Because the network is decentralized, there is no single point of failure or vulnerability. Traditional financial systems are susceptible to attacks or failures as they rely on centralized servers and databases. In a decentralized system, there can never be a single point of failure, and the network can always continue to function normally even if a single node is compromised. The decentralized nature of cryptocurrency also makes it more accessible to people who may not have access to traditional banking services. In many parts of the world, people do not have access to banks or other financial institutions, which can make it difficult to send or receive money. With cryptocurrency, all that is needed is an internet connection and a wallet address, making it easier for people to participate in the global economy. The third feature of cryptocurrency is security. In the context of cryptocurrency, security refers to the measures taken to protect investors' digital assets from theft, hacking, and fraud. The security of cryptocurrency transactions is based on the use of cryptography, a method of protecting information through the use of codes and ciphers. One of the primary ways in which security is ensured in cryptocurrency is through the use of public and private keys. A public key is a string of characters that is shared with others and used to receive cryptocurrency payments. A private key, on the other hand, is a unique string of characters that is kept secret and used to authorize transactions. In order for a transaction to be processed, it must be signed with the private key, which ensures that only the owner of the private key can authorize the transactions. Another important aspect of cryptocurrency security is the use of blockchain technology. A blockchain is a decentralized digital ledger that occurs all cryptocurrency transactions. Each transaction is verified by a network of computers, and once it is verified, it is added to the blockchain. Because the blockchain is decentralized, it is virtually impossible to hack or alter without the consensus of the network. Cryptocurrency exchanges, where the investors buy and sell digital assets, also employ security measures to protect against theft and fraud. Exchanges use two-factor authentication, which requires users to both provide a password and a unique code generated by a separate device to log into their accounts. They also typically store the majority of the customer's asset in cold storage, which is offline and therefore less vulnerable to hacking. Despite these security measures, the cryptocurrency market is not immune to theft and fraud. Digital wallet and exchanges have been hacked in the past, resulting in the loss of millions of dollars in cryptocurrency. In addition, investors must be vigilant in about phishing scams, about phishing, about phishing scams, which attempt to trick users into providing their private keys or other sensitive information. The fourth feature of cryptocurrency is its accessibility. Accessibility is a key feature of cryptocurrency that has contributed to the rising growth as an investment option. Cryptocurrency are highly accessible due to their ease of use and availability of digital exchanges, allowing investors to buy, sell, and trade from them anywhere in the world. One of the primary ways in which cryptocurrencies are accessible One of the primary ways in which cryptocurrencies are accessible is through digital wallet. A digital wallet is a software program that stores digital assets, including cryptocurrencies, and allows users to send and receive them. Digital wallets can be accessed from any device with an internet connection, making it easy for investors to manage their assets on the go. Another way in which cryptocurrencies are accessible is through digital exchanges. These exchanges allows investors to buy and sell cryptocurrencies using fiat currencies such as US dollars or euros or other cryptocurrencies. Cryptocurrency exchanges are open by 7, 24 by 7, which means investors can trade at any time of the day or night. Many exchanges also offer Many exchanges also offer mobile apps, making it easy to access the platform from smartphone or tablet. The decentralized nature of cryptocurrencies also contributes to the accessibility. Because cryptocurrencies are not controlled by a central authority, investors can trade them with anyone anywhere in the world. This means that cryptocurrencies are not subject to the same geographical restrictions as traditional investments, which can make them an attractive option for investors in emerging markets or areas with limited access to traditional financial services. Cryptocurrencies also accessible are also accessible to a wide range of investors regardless of their level of experience or financial resources. Unlike traditional investments, which often require a significant amount of capital to get started, cryptocurrencies can be purchased in small amounts. This makes it possible for an investor with limited resources also to invest in the market and potentially earn high returns. The fifth feature of cryptocurrency is diversification. The diversification is an investment strategy that involves spreading your money across a variety of different assets or investment types. The goal of diversification is to reduce risk and potentially increase returns by investing in a mix of assets that are not highly correlated with each other. In simple terms, diversification means not putting all your eggs in the same basket. By investing in a variety of assets, you're spreading your risk so that if one investment performs poorly, it may be offset by another investment that performs well. For example, if you only invest in stocks and the stock market experiences a downturn, an entire portfolio could suffer. But if you also have some bonds or real estate in your portfolio, these investments may perform well during a stock market downturn, which would help to balance out the losses in your stock holdings. Diversification can be achieved by investing in a different asset class such as stocks, bonds, real estate, commodities, and alternative investments. It can also be achieved by investing in a different geographical regions or industries. However, it is important to note that diversification does not simply guarantee a profit or protects against the losses in a declining market. It simply aims to reduce the impact of market volatility on our overall portfolio. In summary, diversification is an important investment strategy that can potentially reduce risks and increase returns by spreading your money across a mix of assets. By diversifying your portfolio, you can potentially mitigate losses during market downturns and take advantage of your opportunities. Every good thing has a dark side, meaning that cryptocurrency also should must possess some serious disadvantages. So if we begin with the cons of the cryptocurrency, the high volatility is a common characteristic of cryptocurrencies and refers to the tendency of the prices to fluctuate rapidly and significantly over short periods of time. This can make investing in cryptocurrencies a high risk proposition as prices can rise or fall by large amounts in a matter of hours or even minutes. There are several factors that contribute to the high volatility of cryptocurrencies. One of the primary reasons is the lack of intrinsic value of most cryptocurrencies. Unlike traditional investments like stocks or real estate, cryptocurrencies do not have any underlying assets or cash flows that can be used to value them. This makes it difficult to determine their true value and can lead to significant price swings as investors and traders try to access their potential. Another factor contributing to the high volatility of the cryptocurrencies is the relative newness and lack of maturity as an asset class. Many cryptocurrencies have only been in existence for a few years and the market for them is still relatively small and illiquid. This can make it easier for large investors or traders to move the market and cause prices to spike or plummet. Additionally, the lack of regulation and oversight in the cryptocurrency market can contribute to volatility since cryptocurrencies are not currently regulated by any central authority or government. There is little protection for investors in an event of fraud or manipulation. The This can create uncertainty and fear among investors, which can lead to rapid selling and price declines. Finally, the high volatility of cryptocurrency can also be attributed to the speculative nature of the market. Many investors and traders are drawn to cryptocurrencies because of their high potential for returns, which can lead to excessive buying and selling activity as investors try to capitalize on the short term price movements. The second point is lack of regulation. One of the defining characteristics of cryptocurrency is the lack of regulation. Unlike traditional currencies or investments, cryptocurrencies are not currently regulated by any central authority or government. This lack of regulation can have both advantages and disadvantages for investors. One of the advantages of lack of regulation in cryptocurrency markets is the potential for innovation and growth. Without strict regulations, developers and entrepreneurs are free to create new cryptocurrencies and blockchain technologies which can drive innovation and economic growth. Additionally, the lack of regulation can make it easier for small investors and businesses to enter the market, which can promote greater decentralization and diversity. However, the lack of regulation in the cryptocurrency markets can also pose significant risks for the investors. Since there is no central authority of government overseeing the market, there is little protection for investors in the event of fraud. This can create uncertainty and fear among investors, which can lead to rapid selling and price declines. Additionally, the lack of regulation can make it easier for bad actors to manipulate the market for their own gain. Pump and dump schemes, where investors artificially inflate the price of a cryptocurrency before selling it for a profit, are common in the unregulated cryptocurrency market. This can result in significant losses for unsuspecting investors. Another risk of lack of regulation is the potential for hacking and theft. Since cryptocurrencies are not backed by a central authority, they are vulnerable to cyber attacks and hacking. If a cryptocurrency exchange or wallet is hacked, investors may lose their fund with little or no recourse. In summary, the lack of regulation in the cryptocurrency market can be both a blessing and a curse for investors. Okay, so limited adoption is a key issue facing cryptocurrencies. While the number of people and businesses using cryptocurrencies has grown significantly in recent years, they still have limited adoption compared to traditional currencies and payment methods. This limited adoption can make it difficult for cryptocurrency to reach their full potential as a means of exchange and store of value. One of the main reasons for limited adoption of cryptocurrencies is the lack of awareness and understanding among the general public. While cryptocurrencies have received significant media attention, many people still do not fully understand how they work or how to use them. This can make it difficult for businesses to accept cryptocurrencies as payments and for individuals to use them for everyday transactions. My friend Nishan Kohl, who has told me to make this video, himself doesn't know how cryptocurrency works. So, yeah. Another factor limiting adoption is the limited number of businesses and merchants accepting cryptocurrencies as payment. While the number of businesses accepting cryptocurrencies has grown in the recent years, it is still a relatively small percentage of the overall market. This can make it difficult for individuals to use cryptocurrencies for everyday purchases and can limit their usefulness as a means of exchange. Additionally, the limited adoption of cryptocurrencies can be attributed to their high volatility and lack of stability. Since cryptocurrencies are not backed by any central authority or government, the prices can fluctuate rapidly and significantly over short periods of time. This can make it difficult for businesses to accept cryptocurrencies as a payment, as they may not want to be exposed to the risk of significant price swings. Finally, the limited adoption of cryptocurrencies can also be attributed to regulatory and legal issues. Many countries have not yet developed clear regulation governing the use of cryptocurrencies, which can create uncertainty and fear among businesses and investors. Additionally, some countries have outright banned the use of cryptocurrencies, which can limit their adoption and growth. In summary, limited adoption is a key issue facing cryptocurrencies. The lack of awareness and understanding, limited number of businesses accepting them as payment, high volatility, and lack of stability So, in conclusion, investing in cryptocurrency has both pros and cons that potential investors should consider before entering the market. On one hand, the decentralized nature of cryptocurrencies offer greater security and privacy and the potential for high returns through speculative investments or long-term growth. Additionally, cryptocurrency can serve as a means of diversification and an alternative investment option. However, on the other hand, the high volatility, lack of regulation, limited adoption, limited liquidity, and lack of intrinsic value are significant challenges that the investors must be aware of. These risks can lead to significant losses for those who are not prepared for the potential downsides of the market. Ultimately, investing in cryptocurrency should be approached with caution and careful consideration. While it may be a viable investment option for some, it is not suitable for everyone. As with any investment, investors should be research, evaluate the risk tolerance, and seek professional advice before making any investment decisions. In summary, cryptocurrency offers both opportunities and risks. It is up to the individual investors to decide if the potential benefits outweigh the potential risks and to make informed investment decisions based on their own circumstances and risk tolerance. For watching, I will be thank you for watching guys. I will see you in the next video.